Hello, this is Kath Hall and welcome to this eCPD module on accommodation benefit. This module looks at the income tax implications for an employee of the provision of certain types of living accommodation and how it might be charged to income tax, and also the payment by the employer of associated costs with regard to that property. This module will look at circumstances where the benefit applies by reason of employment and certain circumstances where it does not. There are other issues regarding the benefit of what used to be called expensive accommodation, those that cost more than £75,000 originally, and also the issue of costs paid by an employer in connection with the property provided to the employee. This accommodation benefit does not arise in certain circumstances as described above. You can see those categories there: necessary for the performance of duties, customary, or a special security threat. There are more details in the notes, but all categories involve looking at HMRC guidance. Just to take a step back for a second, the accommodation has to be able to be lived in, which I know is a truism, but around the edges there are certain types of properties which are in or out of the benefit regime, or circumstances which are in or out of the benefit regime. The holiday home issue is described a little further in the notes, but living in a hotel for a number of nights does not bring about this benefit. Where an option has been given to live in or live out of accommodation with a higher cash wage, that excess needs to be entered on the tax return, and again that's described further in the notes. On to the calculation of the charge. The benefit applies to all individuals regardless of their level of earnings, and the calculation is broken down into a number of elements. The basic element is the cash equivalent calculation, the starting point, and then there's the consideration of an additional benefit, as mentioned before, on properties which cost more than £75,000. This is the original cost, not the market value, but see later about a little twist on that. And then there's the possibility of the deduction of employee contributions, and then also, again, see later, the issue of costs paid by the employer in connection with the property. On to the calculation of the basic benefit, and this depends on whether the property is owned by the employer or rented out by them and then provided to the employee in both of these cases. If owned, the basic benefit for the employee is the annual or gross rateable value. It's kind of an old statistical value, but they exist, and if not, then a valuation will have to be agreed. If rented by the employer and then provided to the employee, the benefit is the higher of this annual value or the amount of rent paid by the employer. Any contribution by the employee, in plain terms rent paid by them, is deducted, and the benefit is prorated if the accommodation is not available for the whole tax year. This example shows two straightforward situations where the employer owns the property in the first case and provides it to Evelyn, and then has rented the property for the employee Christoph in the second case, where the rent paid by the employer is higher than the rateable value. And now there is an additional part of the benefit where the property provided is owned by the employer and the original cost to the employer is more than £75,000. I know, in property valuation terms that's a low number, but hey, we're just dealing with a tax rule here. The difference between the original cost £175,000 times the official rate of interest at the start of the year, which is 2.5%, is treated as a benefit. That cost figure is increased by improvements prior to the start of the tax year, but there's a little bit more here. Following on from my previous comment, there is an adjustment in calculating this additional benefit where the property is acquired more than 6 years before being provided to the employee. In this case, the original cost in that calculation of original cost minus 75,000 times official rate of interest, the original cost is replaced by the market value when first provided to the employee. The adjustment is essentially where the property is acquired more than 6 years before being provided to the employee in question, although that market value is then increased by the cost of subsequent capital improvements. This example shows a simple calculation of the additional rental benefit, looking at Kane and provision of a property to Serena. The market value is irrelevant in this example given the property was only purchased a year ago and there's no employee contribution. I'm assuming that the yearly benefit is for the current year, and so it's been provided since May 2015 and still provided. There are a number of different treatments of costs, but let's start with the basic issue. If the employer pays costs in relation to the provision of accommodation, that will potentially result in a further benefit for the employee. This is generally calculated as the cost to the employer. Some of the more common examples of when this might arise are shown above: utilities, cleaning, etc. With regard to the provision of furniture, for example a TV, a sofa, which you might expect moving into a place that's been provided to you by your employer, the 25% times cost rule applies to calculate that benefit. However, this benefit may be restricted to 10% of net earnings, where the overall benefit is not subject to tax because of those categories we looked at earlier: necessary for performance, customary or special security provisions. Following on from the last slide, where the living accommodation does not give rise to a benefit, for example security measures or a live-in full-time caretaker who's necessary to be there in the performance of his duties, the benefit regarding costs is limited to 10% of net earnings. This means earnings and benefits less expenses, obviously apart from this one, otherwise you get a circular problem, less allowable deductions and occupational pension contributions. There's also a tax break in certain circumstances with regard to the payment of council tax for these similar circumstances where the basic benefit does not apply due to the circumstances of the provision of accommodation. That council tax bill is not taxed. The key things to remember from this module are that an income tax benefit will arise on the provision of living accommodation in many circumstances. However, there are some situations where this benefit does not arise. The benefit calculation has 3 elements: the basic benefit and an additional yearly benefit for properties costing more than $75,000. And then there's the possibility of costs paid by the employer being taxable on the employee. I trust you found this module on benefits accommodation informative. Goodbye, and thank you for using Croner-i eCPD.